On the next slide, a little about this program. The CFEE and the National Bank have partnered to offer post-secondary students across the country access to financial literacy workshops. The program, Help Managing Your Money on Campus, is designed to help support young people by providing you with comprehensive financial education modules. So this is important and timely because more than ever, we live in a complex financial world. The majority of you have likely already experienced this world of financial costs, responsibilities, planning, spending, debt, credit cards, and much more. And that's exactly why we partner with universities and colleges across the country to help equip students with the information you need to take on all life's financial challenges. We ask students what their priorities are in the first half of 2020, what they want to learn about. So 1,500 surveys later from students across the country, and this is what we found. So our research identified that nearly two-thirds of students are currently dealing with financial stress, plus 57% of students are looking for help preparing and working with a budget. Not only that, but half of students also reported having difficulty generally knowing how to manage their finances. We hear your concerns and we understand your challenges. That's why we put together today's presentation. Today, we're going to talk about 4 major topics. First, we'll discuss the value of goal setting and how you can do it in a smart way. We'll talk about the components that make up a SMART goal and how you can apply them to your life, especially when creating a budget. Next, we will talk about budgeting and spending and where you can control your spending. We will then look at different ways to save your money as international students. Finally, we'll look at one of, if not the most important financial matter topic that affects international students, and that is taxes. We're going to walk you through the basics of the Canadian tax system and what you need to know about it as international students when filing your taxes. So coming out of this workshop, we all hope that you have a better understanding of how setting goals can help lead to more financial security, different methods to budget, some tips for your spending, and how savings needs to be a key component of a budget. This can allow you to take more control of your money. And 3, you will also have better understanding of Canada's tax system and possible ways to invest more tax efficiently. So, with the new year typically comes a desire for new goals. I know, it's a fresh start, a new beginning. As someone who usually sets resolutions myself, the beginning of a new year is a time for reflection and mostly a time to strive towards goals that seems lofty or idealistic. For many, some of these goals can range from taking more time for self-care practices on a monthly basis, going to the gym more to lose weight, or simply saving more money either to go travel or, say, buy a car. These resolutions or goals seem easy enough to follow, but why is it that many people who set them still fail in achieving them and often never achieve them at all? So for our first topic, we are going to talk about goal setting and how to do it in a smart way to get you on the path of living a financially healthy life. So let's get started with goal setting. Here's what we are going to cover in this section. First, we're going to talk about what exactly financial freedom means. Second, how to achieve financial freedom and how setting SMART goals can help. So, financial freedom is a term that we often come across nowadays. Different people come up with different definitions. Some say it's about buying what you want and when you want, having no debt, being able to support yourself, or simply being rich. Well, these are just vague and half-baked answers. So what is financial freedom anyway? In general, financial freedom means that you get to make life decisions without being overly stressed about the financial impact because you are prepared. You control your finances instead of being controlled by them. It is not about being rich at all and having a ton of money at all, but having enough to cover your expenses so that you can spend your precious time what you like doing rather than doing things just to earn money. You're living your life not just to survive, but also to thrive. So, the path to financial freedom isn't a get-rich-quick strategy, and a financial freedom doesn't mean that you're free of the responsibility of handling your money well. Quite the opposite. Having complete control over the finances is the fruit of discipline, hard work, sacrifice, and time. Financial freedom has to be personal. To know how to achieve financial freedom, you must first ask yourself, what does financial freedom look like for you? Is it the freedom to choose a career you love without worrying about money? Freedom to travel places you've never been before without it breaking your bank account? Perhaps even freedom to retire a whole decade early? Whatever it is, to achieve financial freedom, you must first identify what it means for you. You need to be specific. Next, you need to learn how to manage your money by making a bank and budget, and especially routines, to stick to it every month. Building wealth is impossible if you're living paycheck to paycheck. You won't get to financial freedom on accident, and budgeting is the crucial step to building wealth on purpose. Once you start learning how to manage your money, you may realize you've made some mistakes with your financials in the past. That's okay. But if you want to experience financial freedom, you must clean up the mess before you can start building wealth. Paying off your consumer debt must become your prime concern. After you've kicked your consumer debt to the curb, it's time to make savings and investing a priority for you. Investing is another way of saving. So this is like making your money work for you by means of dividend income or interest. In order to invest, you must have money saved up. The sooner you get to saving, you'll be able to invest. So there's no shortages of advice you are likely to receive about how to effectively manage your money and what you should be doing with your money. But in the end, you will decide what your needs and what your wants are. So you need to know what you really want to do with your life. So a key factor that can affect your decisions are your goals. If you don't have goals, then goals won't play a role in your money decisions. But if you have goals, hopes, and things you want to achieve in the future, they will have an impact on the decisions you make. Therefore, setting goals for yourself can be a powerful incentive which can have an effect on the decisions you make. So, why can goals make a difference? If you have goals, you'll have to consider the possible trade-offs as you make decisions today. And saving to achieve a goal can be very rewarding, personally satisfying, a real motivator, and a confidence builder. Achieving a goal can help you prove to yourself that you can accomplish what you set your mind to and inspire you to aim for other goals and to achieve other things. A lot of good money habits is about changing your behaviors and building upon your successful achievements of various goals. So one of the things that I would personally recommend for changing your habits would be to read Atomic Habits. There's an audiobook, and you can also purchase it just in any other bookstore. It's a great way to use little small habits as a start to build on big habits and to change your behavior that way. So, though money doesn't buy happiness, it does play an important role in most people's lives. We may wish it weren't so, but it's true. Earning money, spending money, saving money, investing money, making money, and losing money, or giving money away, we make all kinds of decisions, often daily, about money. Money can help us out, but can also cause us some problems. Getting deep into debt, causing stress, tension, and anxiety, pushing some people to the curb, having bill collectors or your back. To avoid many problems, it's best to try and stay in control of your money and how it affects your life. You want to maximize the help that money can provide and minimize the problems it can cause. Today, it's the best time to start to take control of your money, and the best way to take control is to be prepared and plan. Planning how to handle your money is not only for those who have lots of money. In fact, the less money you have, the more important it is to plan. You want to get the most from the money that you have. Okay, so now it's time to build the plan. Consider the different time periods. The short term, what you hope to achieve over the next year, possibly even the next week or month. The medium term, which is 1 to 3 years, or the long term, 3 to 5 years. And the more distant future is 5 years and beyond. Short-term goals can be very helpful as they serve as stepping stones to achieve your medium-term goals. As an example, if you're looking to save up for a car, break it down into monthly savings goals over the next few years. Then use medium-term goals as a stepping stone to long-term goals and so on. Doing this gives you some checkpoints to see how you are doing over time. And think about whether your goals have changed and if you want to change direction. As you succeed with your goals, find a way to celebrate those goals and be proud of what you have accomplished. If you are in your teens or early 20s, like me, Your thoughts are probably mostly on personal relationships, your education, your job, or work opportunities. However, you will also want to make sure that you have a priority in entertainment, sporting events, and travel. You're probably thinking about possible careers, education options, work opportunities, and prospects, perhaps moving out on your own. Over time, though, at different life stages, our priorities and concerns can change and will change. Taking control of your financial affairs means thinking about the various stages of your own life cycle. You can't think only about what is important today. You also have to think about what it will be important to you in the future. At a future stage in your life cycle, finding a balance between today and the future is important. Develop a plan that helps you live as a happy life as you can, today, next month, and into the future. So let's talk about setting goals. So goal setting is an action-based process. Because financial freedom and well-being is a long-term commitment, you need to set SMART goals so that you don't lose momentum along the way. So what does SMART mean? It's an acronym for specific, measurable, attainable, realistic, and time-based. The basic idea is that you go through each of the 5 terms using a worksheet so that you can determine exactly what you want to achieve. In doing so, you determine how to measure your progress, whether the goal is realistic, how relevant it is to your life situation, and how long it will take to complete. Writing SMART goals entails working through each of the 5 components to build a measurable goal that encompasses exactly what needs to be accomplished, how to accomplish it, and by when. This approach eliminates generalities and guesswork, sets a clear timeline, and makes it that much easier to track progress and identify missed milestones. Long story short, it can help you hold yourself accountable in achieving your goals. So here's a worksheet you can use after this workshop to set up some SMART goals. This worksheet provides you with some questions to ask yourself to ensure these goals are SMART. This is included in the resource document you will receive after this workshop. So we hope that you will set SMART goals using the goal worksheet after this workshop, and hopefully this will help you maintain and obtain the goals you would like to set for yourself and achieve. So a few key takeaways from this section. What does financial freedom mean to you? You need a map to get to your destination. Goals should be the most important factor in decision making. 3, to achieve your financial freedom, you need to set SMART goals. So with the new year, it typically comes a desire for new goals, a fresh start, a new beginning. As someone who usually sets a resolution, we need to make sure that these goals are set priority to what we want to achieve in the future. So let's start with budgeting. Here's what we are going to cover in this section. First, we're going to define some foundational terminology for budgeting. Second, we will talk about why we budget. It's not meant to be a straitjacket that controls you, what you do, but rather a tool to give you freedom to control your money. And third, we will describe a few tried and true techniques to budgeting. To fully understand and grasp the basics of budgeting, we have to know 3 terms we use in building a full budget. First is a personal net income. So this means income is how much money you bring in on a regular basis, usually either monthly or annually. For example, if you make $1,000 per week, you will have a monthly income of about just over $4,000 and an annual income salary of just over $52,000. However, this isn't the same as your personal net income. Income represents money that comes into your personal household, usually as compensation for your work that you have performed. Once you subtract expenses such as income taxes and pre-tax contributions, you'll arrive at your personal net income, which is the money you actually receive and can spend. So I think an important thing that you may have available to you would be, for me, I have the CIBC net bank account, and it provides me with insights into how much I make per week, or if you're paid bi-weekly, how much you make per month and how much you spend on entertainment. So this can facilitate better learning on where your money is going. It can hold it accountable, and you will know that it's not just going anywhere, but where exactly it is going. And next is fixed expenses. The definition of fixed expenses is any expense that does not change from period to period, such as mortgage or rent payments, car insurance, and your phone bill. In some cases, the amounts may vary slightly, which may be the case with utilities, but They are due on a regular basis, be it monthly or annually, and they are something you have to pay, and be certain that you pay it on time. Lastly, variable expenses. The definition of variable costs can differ, but we like to define them as anything you can buy in a store, for example, groceries, gas, or coffee, or expenses that are within your control. You can decide how much and if you will spend on these items. In other words, these are expenses that at your discretion. Now that we've got three important terms, let's move on to the basics of budgeting. Budgeting is the process of creating a plan to spend your money. This spending plan is called a budget. It is simply balancing your expenses with your income. If they do not balance, you spend more than you make. You will have a problem. So you basically want to make sure that you aren't spending more money than you're making. As Dame Ramsey, an American personal finance advisor, once said, a budget is telling your money where to go instead of wondering where it went. Many people don't even realize that they spend more than they earn and slowly sink into deeper debt every year. Now, if you're new to budgeting, it can be difficult to know where to begin. There are several different methods, and the effectiveness of all of them will vary depending on your personality and financial situation. But let me reassure you, there is a budgeting method for everyone, and it's never too late or too early to start. While it can be tough to know which budgeting method is best for your lifestyle, especially if you're new to the whole thing, it can help by start pinpointing your biggest money issue and then working backwards. There are three methods of budgeting I will be covering in this section, and you may or may not have already heard of them. These are zero sum or 50-30-20, pay yourself first budgeting. So a zero budget requires you to spend every dollar you earn on paper and gives each dollar a job. This ultimately results in a checking account balance at or near zero at the end of each month. After all, fixed and variable expenses and saving have been taken care of. At that point, you start the next month over and with a new spending plan and a clean slate. Let's say you earn $3,250 a month. After tax, once you graduate, everything you spend, save, give, or invest should add up to $3,250. Same. That way, you know exactly where every one of your hard-earned dollars are going. You could be setting yourself up for a disaster if you don't know where your money is going each month. It's no fun to look up one day and find out you have no money and no clue where it all went. The 50-30-20 budget allocates 50% of your personal net income for your essentials. So these are like rent, utilities, and groceries. Then the 30% of your budget is for your own discretionary spending, like eating out, attending concerts, or going shopping. Then the remaining 20% of your budget goes towards your savings or paying off debt. The principle itself is simple enough. Divide your income into three categories so that you can live your life to its fullest, but you're also maintaining a proper budget. And this is important because you'll still have enough left over for your future. Keep in mind that your percentages may need to be adjusted based on your personal circumstances. So this means if you're not one who likes to go out for cocktails with friends, or you don't feel the need to splurge on new tech, you can lower your 30% allocated for your wants to 20% or less. And then you can use the remaining 10% or more to your savings. Also, when you're a student, your needs could well be above 50%. And so that would need to be reflected in preferably lower wants than 30%. So paying yourself first simply means putting money into your savings account first, as soon as you get paid and before you spend money on anything else. Most people prioritize their spending in this order: bills, fun, saving. However, in most cases, there's little left over to put away in savings account, let alone to invest. If you pay yourself first, saving bills, fun in that order, you set the money aside before you find other reasons to spend it. You will need to gauge how much you can save through some trial and error. A good rule of thumb is to be saving 10% of your take-home pay. If you can save that amount or more, that's great. If you can only put away $20 per month, that is good too. Try to put away more as a percent of your income over time. Don't spend all the raises you get through work, but rather use some of those raises to put money away for savings. Having some savings also allows you to persevere through life's challenges. A general rule of thumb is to try and build up 3 to 6 months of your personal expenses into a rainy day fund or an emergency fund for those unexpected things in life. New tires for your car, for example, it's winter time. We should be getting winter tires for our car. Or if you're like me, getting your wisdom teeth removed this year, that sucks. And paying yourself first has been a standard recommendation from a lot of financial experts because it paves the way to financial freedom faster. By paying yourself first, you are mentally establishing saving as a priority and putting yourself in an investor mentality. All budgets should have a line for savings. It should be one of your fixed expenses. So now we have our Zoom poll that we prepared. So we just ask that you answer the question, and then we will report on what people talk about. Good. So far people are answering correctly. Everyone's getting the right answers. That's great.
We'll just give it a few more seconds and then I'll end the poll.
Perfect. Okay, so some key takeaways from this section. One, once you have a plan for your money, it gives you the freedom to control where you spend your money and helps you to enable a plan to move forward with financial freedom. Two, budgeting is a unique process for each of us. Find the method and approach that works best for you. The approach that works best for you is the one you will keep doing every month. So that means month in and month out. And that as simple as possible. So you want to keep goals simple and easy to do so that you will be more likely to complete them. And this creates a better saving habit. So you want to be patient as it will take time to get to a stage where you are confident in managing cash flow. And three, be sure to have a line item in any budgeting approach for savings. Without that, you will likely never get around to building up enough savings. Savings is one of the two components to Canadians having financial well-being. The other item is not to use credit for everyday purchases. You can read up more on FCAC study of financial well-being at the website that Melanie has posted. Now that you know the three basic budgeting methods, let's go over the most important financial matter affecting not only international students like you, but also pretty much everyone, which is spending money. After all, we budget to understand our spending patterns in order to minimize it the best we can. So in this section, we're going to go over some key things to keep in mind when it comes to spending money as international students. Let's get started with spending. We are going to discuss the top 3 areas where we will tend to spend the most money and give you some tips on how to save on each aspect. How much you should be spending on rent, food, your phone bill, and the other necessities of being an international student in Canada? Well, ideally, as little as possible, but we know that that's not always the case. So in this section, we're going to help you navigate the tricky waters of spending your money to cover the necessities, which we've identified as accommodations, affordable phone plans, and food cost. One of it, if not the most aspect of being an international student, is your living situation. Many students, both domestic and foreign, often struggle with the decision to live in residence on campus or find off-campus housing. It's often promoted as a great way to become engaged in campus life, to make friends, and it's relatively risk-free way to those first, tentative steps towards independence. Residence prices vary across the country. Depending on which university you attend, living in a campus residence can burn a serious hole in your pocket, and it's often more expensive than living off campus because you're paying for the convenience and amenities, as well as the overhead costs for running a school. Because of this reason, many students opt out of living in residence and starting finding newer, cheaper accommodations off campus. So, to put things into perspective, the cost of a double room at University of Guelph's residence is just over $6,000 for 8 months of classes, which is similar to Lakehead. The purchase of a meal plan is a necessity and necessary to live in residence there, and it's also the necessary aspect of living in residence at Lakehead. And this can cost just about under $12,000, I believe. But this also is excluding extraneous monthly spending. So say, for example, if 4 students decided to rent $18,000 or an $1,800 house in Guelph for $450 a month each, with the added utilities and internet costs of $65 per person. That would mean $250 a month for groceries and $80 a month for bus pass. Living off campus would cost relatively just under about $7,000 for 8 months, excluding extra spending, and a potential cost savings of just under $5,000. If you're planning to live off campus, go to a neighborhood that is safe, but make sure that it's not trendy, because then you won't be paying for the up and coming, or you won't be paying for the well-known, but you'll be paying for the up and coming, and avoid paying ridiculous amounts of rent. If you do want to save some money, try to find some roommates. Rents in major cities like Vancouver and Toronto start around $1,500. I think in Aurelia it is similar to this, but I think it's a bit less. I think it's around 1,000 or just under. Having roommates means splitting costs like internet and utilities, and they can also make for great social resources and will keep loneliness at bay when you're in a new city. Make sure you think ahead about what qualities you want in a roommate, and maybe do a background/reference check, as well as confirm with your landlord that roommates are allowed. That is the most important one. Finally, to cover yourself from any possible risks, make sure to get everything in writing. Tenancy agreement protects not only your landlord, but also yourself in sticky situations. So make sure that you have it ready, because if you ever have to go to court or a lawsuit could ensue, you would have it in writing, and then it would be all covered for you. It's better to get a standard contract and asking your roommate so that it feels more guaranteed of shared rent. So you want to make sure that you're paying fair shares and that you both decided and agree on the terms of the renting conditions. So the second biggest and most important cost you can incur when you're living away from home is your food and groceries cost. The truth of the matter is that people often spend far more on their food than they realize, and that those food expenses really add up over time. Here are some tips to keep in mind to lower your monthly food expenses. 1, decide what to eat and meal prep. Weekends can be a great time for meal prep. Prepare and freeze or refrigerate enough food for a couple of days or an entire week. Not only will this save you time, but it will also save you a ton of money by eating out less. So if you're coming to Lakehead during the day, you may want to pack a lunch. Stick with the generic or store brand of groceries whenever available. The ingredients are usually similar to the brand name versions, but you're not shelling out extra money for the brand name. 3, look at a unit price, like buying gasoline. Know how much you are paying per unit of something from the grocery store, like liters of gas or napkins in a package, and buy once that unit is cheaper. But don't make the mistake of buying a large amount of something just because it is cheaper by the unit. You need to make a careful choice here of the right price per unit and quantity that you would fully utilize and not end up wasting. Create a shopping list and stick to it. Plan your meals ahead of time and know the ingredients for each meal. The time you spend planning will end up being the time you save while you're shopping, because the longer you're in a supermarket, the more likely you are to spend more money than what you originally planned. I vouch for this because whenever I have stepped into a grocery store without a list, I kid you not, I go from the start of the store till the end of the store, because I feel like this way I will see everything that I want. But in this process, I see items I want and what I do not need, ending up spending on extra things. So I would recommend looking to buy in bulk and to split costs with your roommates. However, I would also recommend the www.flip.com and Reebee.com. They are websites that will show you the best deals in your area. And I think that's pretty good, because then you can go and while you're in the area, say like you're at Lakehead Aurelia or Lakehead Thunder Bay, the closest grocery store I think in Thunder Bay is the Walmart, and the closest here in Aurelia I think is Food Basics or Costco. So that website will help you track what is on sale at what times. And let's move on to the next section. So cell phones are a must-have for college students everywhere, and Canada has some of the most expensive wireless data costs in the world. It's a well-known problem for most Canadians that many tourists and newcomers often always point out. After your monthly housing, grocery, and utility costs, it might just be the next priciest thing in your entire budget. So how can you lower this fixed expense? Here are some tips we have. 1, try out smaller carriers. So the big 3 that we like to call in Canada are Bell, TELUS, and Rogers. However, you may want to try the bargain basement carriers because they have discount prices. This is For example, Public Mobile, Freedom, and Lucky Mobile. Similar carriers often use the same coverage as the larger companies, so don't shy away from their month-to-month plans. 2, avoid subsidized phone traps. While a $0 down iPhone sounds like a great deal, it's probably not so sweet over the course of a 2-year contract. In fact, after you add up the monthly fees for financing the phone, you might even be paying more than the retail for that flagship phone. Our advice is to buy a used phone and then selecting a cheaper monthly plan without the phone payment built in. This could end up saving you hundreds of dollars. 3, shop around for the best deal. Costco will have sales a couple times a year where they will give you a large amount of gift cards. Also, other carriers will give you deals on days like Black Friday, which is in late November, or Boxing Day, which is the day after Christmas, so the 26th of December. Use Wi-Fi whenever you can. One of the easiest ways you trim your cell phone bill is to cut out extra data charges by using Wi-Fi available to you in your surroundings. So you can go to places like the cafe, Lakehead. We have free Wi-Fi here on campus, but a key tip I would also use if you have an iPhone like me is to go into your Wi-Fi settings or your cellular data settings and check off the cellular data assist. So this means that your Wi-Fi is assisted by your cellular data, and this can eat up your cellular data plan. So that brings us to the end of this section. And so here are some key takeaways we discussed. The top 3 areas where you will tend to spend the most money and give you some tips on how to save some money on each aspect. So as we have mentioned, in the 3 months of budgeting, saving should be a part of your budget, a fixed part of your budget. By making saving a priority for you, you are putting yourself in an investor's mentality, which is generally laying down the strong foundation you need to have on your road to financial freedom. In this section, we are going to talk about the things that you need to know about while saving and investing your money. So let's get started with saving. Here's what we are going to cover in this section. First, we're going to explain why it's important to save. From trying to get a bigger item for, say, a laptop, car, or travel, house or retirement, or just to give yourself more financial resiliency when life throws you a curveball, like the pandemic, for example. Savings can be a huge benefit. We will then talk about 2 tax advantage programs in Canada. So these are a tax-free savings account, or TFSA, and a registered retirement savings plan, an RRSP. So why save? 1, grow your money. Let's be honest, we all like the idea of making money without having to work. Good news, this is exactly what happens when you put your money in a savings account. Your investments generate interest, which generates more interest. This is called compound interest. 2, achieving your goals. No matter the goal you're trying to achieve, the secret is saving systematically. Having money in your savings account will help you afford some of the more expensive things in life, be it traveling, investing in a car, and nowadays in education. 3, saving your money can also help you reduce your taxable income. Yes, you heard that right. Let's move on to the next section so you can find out more about this. One of the most common questions out there is whether to invest in a registered retirement savings plan, RRSP, or a tax-free savings account. Both will help you save and save on taxes, but each works in different ways. Understanding these investments will help you know when to use one or the other and when you can use both in tandem. So a TFSA stands for tax-free savings account, as I've mentioned. You don't need any earned income to contribute to a TFSA, which may be more advantageous for international students if you work limited amounts a year. The gains you make from any investments and savings in the account are tax-free, meaning all yours. It's a great incentive for saving and for maximizing any earnings you may get. But the name savings account is actually misleading. A TFSA functions instead as an investment basket. You can pick what you put into the basket from a wide array of financial assets: exchange-traded funds, guaranteed investment certificates, stocks, bonds, and yes, actual savings accounts. That means that you're not limited to the measly interest rates, usually way under 1%, that traditional savings accounts usually offer. TFSAs also have very few withdrawal rules associated with them. You're free to withdraw at any time without penalty, but there are government-mandated limits to how much you can contribute every year. The maximum you're allowed to put into a TFSA each year is known as the contribution limit. For 2021, it's $6,000. Additionally, you can carry forward any unused contribution room. RRSP is a government-sponsored retirement plan with significant tax benefits, but it works a bit different than a TFSA. An RRSP is what's called a tax-deferred account, meaning that the government created them specifically to provide tax breaks to those who invest money in RRSPs as a way to motivate them to put away money for their retirement. But instead of earnings being tax-free, as is the case as a TFSA, any money you contribute to an RSP will exempt you from income taxes the year you make the deposit and will only be taxed years down the line when you withdraw it, so when you're retired. RSPs are therefore an effective way to cut down a current year tax bill. The deduction limit is usually 18% of your income of $27,830 for 2021, which is less. Now that we've covered some fundamental differences between RRSPs and TFSAs, the question is, which one should you be using? The rule of thumb all depends on your income level, what you think you'll be earning in the future, your spending habits, and your savings goals. In an ideal world, you'd be able to contribute to both an RRSP and a TFSA and meet the maximum contribution each year. But that's simply not financially feasible for everyone, so it becomes a question of identifying which account is better suited for your particular financial goals and situations. So we prepared another Zoom poll. Can international students open a TFSA or an RSP? Perfect. It looks like everyone got the right answer. Yes, if you are 18 years or older and have a valid social insurance, you can open an RSP. Great. So any individual who is 18 years of age or older and who has a valid social insurance number is eligible to open a TFSA. If you are a US citizen, though the beneficial tax treatment of a TFSA will not be valid when you file your US income taxes, given that the US taxes you on your worldwide income. Also, any contributions made while you are non-resident will be subject to a 1% tax for each month the contribution stays in the account. International students may begin contributing to an RRSP or a registered education savings plan before obtaining or applying for permanent residency, as long as you have a social insurance number and have earned income and file a income tax return in Canada. Some key takeaways from this section: 1, saving and investing your money can make it work for you. 2, know the benefits of TFSAs. And 3, know the benefits of RRSPs. Now that we've covered savings and how it can help you reduce your taxes, let's move on to our next section, which is Canada's tax system and how it affects you. In our last section, we gave you an overview of the Canadian tax system. To learn more about the taxes, CFEE also has a full workshop on understanding personal income taxes in Canada. Canada's tax system is progressive. This means that as you make more money, you will pay more taxes in both dollar terms, but also percent of income terms. For an initial taxable income up to a little under $50,000, you pay 15% federal taxes, but then once you make more than the lower bound of the first tax bracket, you will pay 20.5% taxes on that income. Provincial taxes are in addition to federal taxes. We will then describe some important nuances about the tax system and how you can save taxes, deductions, and credits. Lastly, we'll help you understand who needs to file Canadian taxes and also the deadline to file your taxes. Canada's tax system is based on the self-assessment principle, which means that you must complete a tax return each year to report all your income sources. So this means wages, tips, bonuses, scholarships, or bursaries. The Canadian Revenue Agency, CRRA, declare your eligibility for any deductions or tax credits to calculate whether you owe tax or received a credit refund. The CRA is responsible for collecting taxes and other amounts such as federal, provincial, and territorial income tax and goods and service tax. It collects this money to pay for the government's operating expenses and delivery of services. Taxes are the reason we have the military, police force, libraries, high schools, roads, and hospitals, even prisons. The government also chooses to redistribute much of these taxes to lower income and vulnerable Canadians in the form of child benefits, employment insurance, old age security, and social assistance. Canada has a progressive tax system, which I've said, which means the more you earn, the more you pay. Under this system, money is divided into income tax brackets, which determines the applicable tax rate. A common mistake is to assume that all income is charged at the rate of its highest tax bracket. In fact, we are charged progressively, which means that first you pay the rate in lowest bracket and only pay the high rate on each additional dollar. This is called your marginal tax rate. For example, if you earn $1, you'll pay 10%, but on the second dollar, you'll have to pay 20%, and on the third dollar, you'll be on the hook for 30%. But you never have to pay 30% of $3. Instead, you paid a total of just 60 cents, which works out to an average rate of just 20%. The deadline to pay taxes for those who earn enough to do so can be confusing because the date you must pay does not always line up with the date you must file. Employed individuals have the same payment and file date, which is April 30th. That's because their taxes usually get taken off as the source on each paycheck, and so their tax calculation is simpler. Self-employed individuals must pay any taxes owed by April 30th, but they have until June 15th to file their return. That's likely their taxes are more complicated. They are responsible for setting aside money throughout the year, keeping organized books, and for storing proof of expenses. The CRA charges a fee for late filers, 5% of your balance owed, plus an additional 1% for each month late. Note the term taxable income. That is because you may not be taxed on all your income. Certain deductions may be able to be claimed to arrive at a tax income. For example, if you make a contribution to your registered retirement savings plan, that amount may be deducted from income, reducing the amount of taxes you have to pay. So for example, if you earn an amount of $60,000 and put $5,000 into RRSP, then you will be taxed on the adjusted amount of $55,000. When you're able to deduct money from your income, your total income, and hence your marginal tax bracket, is very important. For the highest earners, an RRSP contribution is much more valuable in terms of dollars and percent of contributions you receive back to the government. Some other examples of deductions include moving expenses. If you have to move more than 40 kilometers to take a job, and childcare expenses for children under 16 years old, make sure to keep all your receipts when you move. There are also tax credits. Deductions from income reduces your taxes income, whereas tax credits are an amount that reduce the tax you pay on your taxable income. The more tax credits that apply to you, the more you can reduce your tax income. Everyone who files a tax return gets the basic amount, BPA, as a non-refundable tax credit. It reduces your taxes payable, and if you earn less than the 2021 federal filing amount of $13,808 rather, you will pay $0 in federal income taxes. But if you don't owe any taxes, you won't generate a tax refund, thus the non-refundable tax label. Certain medical expenses over a certain dollar amount each year or charitable donations can also result in tax credits that can reduce taxes payable. Make sure to keep all of your medical and donation receipts as you pay for medical costs and make donations. So, moving on, we have a short video here that shows and explains the differences between deductions and credits. It's a US video, but the concepts are the same here in Canada.
Filing taxes is really nobody's idea of a good time, but one small joy you can get from it is in watching your tax bill go down as you add in deductions and credits. But what exactly is the difference between a tax deduction and a tax credit? Aren't they kind of just interchangeable? While both can be good for your final tax return, they are very different. First up, let's look at tax credits. A tax credit reduces your overall tax liability. So if you have a $1,000 tax credit, that means you no longer owe $1,000 on your taxes. A tax deduction reduces how much of your income gets taxed. Let's say you have a $1,000 tax deduction. It is applied to your top income tax bracket. So if you made $55,000 last year, your top tax bracket is 22%. That deduction means that $1,000 of your income won't be taxed. So you save that 22%, which would equal $220. This all makes tax credits sound pretty great, right? Most of the time, yes, but there are some catches. Many tax credits aren't refundable. What that means is, let's take this $1,000 tax credit again. But let's say you only owe the IRS $600. You don't get that extra $400. Not all tax credits are non-refundable, but many popular ones, like the lifetime learning.
Okay, so we paused it at 119 because some of the information afterwards is only in reference to the US. So what that video showed there is only what was referenced to Canada. Now we're going to go international students and how they can study in Canada and how they may have a difficult time in determining whether they should file Canadian income taxes. This is understandable. So first, this is because international students do not always owe taxes or qualify for refunds or taxes credits. Here are the basics for determining whether or not you need to complete a tax return. So 1, Canadian earned income is always taxable in Canada. Employment with a Canadian company is a clear indication that you should file a tax return, both a residence and non-residents. As such, international students employed in Canada may find themselves either owing tax or being owed a tax refund. Students who have established significant residential ties to Canada can be considered residents of Canada. Significant residential ties include a home, whether owned or rented, a Canadian bank account, or a driver's license, living with a spouse or dependents, or other significant social ties to Canada. Like all other Canadian residents, international students under this category are eligible for GST credits, tuition carry-forward credits, and other provincial credits or tuition rebates. Tuition students who spend less than 183 days or 6 months in Canada and who do not establish residential ties in Canada are generally considered to be non-residents. Non-residents are not eligible for benefits and credits and are only required to file a tax return to pay taxes or to receive a refund if too much tax was paid on income from Canadian sources. This also applies to deemed non-residents, who are students who have established significant residential ties with Canada but are considered residents of other countries with which Canada has a tax treaty agreement. So this residency status is determined by the Canada Revenue Agency on a case-by-case basis. If you aren't sure of your status, it is best to contact CRA directly for guidance. And there should be a link in the chat soon of the website that lists some important information for international students and their residency status. So here is a little checklist that you can use for your tax filing journey in Canada. Keep in mind that most common expenses that students can claim as non-refundable tax credits are tuition fees, medical expenses, interest paid on your student loans, and donations. You may be eligible to deduct certain expenses from your tax payment against your Canadian earned income. Moving expenses such as transportation and storage of personal effects, travel, and temporary accommodation may be considered eligible for deductions. Save your receipts. However, you can't deduct moving expenses if your only income at the new location is scholarship, fellowship, or bursary income. That is entirely exempt from tax under the current legislation. Additionally, in order to claim expenses in Canada, you must keep documents proving them for a period of 6 years after you have notice of assessment issued by the tax office. Some key takeaways from this section: 1, understanding the basics of Canada's tax system works. 2, determining whether you have to file a tax return, are you a resident or non-resident? And 3, checklist to go over in your tax filing journey in Canada. Let's review what we've talked about today. So some key takeaways are that we hope that you have some information on making decisions and good money decisions, and you've taken the time to think about the why as to why you spend. And 2, you need to map your destination. Goals should be the most important factor in making decisions. 3, to achieve your dreams, and you need to make smart goals to achieve those dreams. Next, once you have a plan for your money, it gives you the freedom to control where you spend your money and helps to enable you to move forward with your financial freedom. 2, budgeting is a unique process for each of us. Find the method and approach that works best for you. The approach that works best for you is the one that you keep doing month in and month out. Remember that book reference I mentioned earlier, Atomic Habits, and make sure that the habits that you have are easy and just very accessible. So even just starting by making your bed a day can help you motivate yourself to keep on track with your spending habits and keeping your room clean and things like that. Keeping yourself on a schedule. 3, be sure to have a line item in any budgeting approach for savings. Without that, you will likely never get around to building up savings. Savings is one of the 2 components to Canadians having financial well-being. The other item is not to use credit for everyday purchases. You can read up more on FCAC study of financial well-being at the link provided in the chat. That brings us to the end of this section, and here are some key takeaways. Saving and investing your money can make it work for you. Know the benefits of the TFSAs and know the benefits of the RRSPs. Understanding the basis of Canada's tax system and determining whether you file a tax return, are you a resident or non-resident, and the checklist. Coming out of this workshop, you should now feel comfortable with the following. Have a better understanding of how setting goals can help lead to more financial security. 2, different methods to budget, some tips for your spending, and how savings needs to be a key component of a budget. This can allow you to take more control of your money. 3, you will also have a better understanding of Canada's tax system and possible ways to invest more tax efficiently. So what we ask you to do after this session is to figure out a SMART goal that will help you succeed on your journey towards financial freedom. Learn about deductions and credits you may be eligible for, and keeping a running total of those items throughout the year. It can be a great return on your investment. Try some of the budgeting approaches suggested and find one that works for you. Perhaps this can be a SMART goal. Consult the CFEE program resources for more references.